Hello and welcome to Exchanges for another week. Intrinsic value, or what is the underlying worth of what you do, your brand, your business. How do you use that to expand your business? Because as my guest today will point out to you, it's actually the most valuable thing you have. This is a huge topic, and I recommend you getting your pencils out very quickly along with your notebook, because what my guest in Michael Masterson has to say today is one of the most incredible interviews I think I've done for Exchanges. And with that, I'm going to stop because he speaks for himself. So with that, here is this week's Exchanges with Michael Masterson. Michael Masterson, welcome to Exchanges. The first real question, and probably the simple question to ask you, take me through intrinsic value.
Oh, gee, I thought you were going to pick something easy to begin with.
Right? I know. Like, that term baffles everyone whenever I sort of sit there and go, oh, that's got intrinsic value. They're like, what? So yeah, good luck. Have fun.
Yeah, look, no, thanks for that. Gee, you didn't warn me about that bit. So, look, I think the easiest way that I like to think about it, and it's only taken me 40 something years to work this out, because when I first became a CEO, I couldn't even spell this IP stuff. I
Yep.
genuinely couldn't spell IP, which is weird because I joke that I am now one of the world's recognized IP experts. And one of the things that I initially kind of worked out is that I got involved in this kind of IP world. And if I'm being honest, for the first couple of years, I'm kind of like, what are they all actually really talking about? Because it was a legal language to me. It wasn't a business language. And then you sort of work out that it's kind of this, there's actually two parts of IP, and I'm getting to where intrinsic assets sits, but you've sort of got to understand where it comes from to work out why we believe it's the right term to explain what everyone's trying to explain. And that is that there's two kinds of IP. There's what's called registered rights, which everyone knows, patents, trademarks, etc. But actually most IP is non-registered. So it's intellectual property, but it's things like, trade secrets and your knowledge and your know-how and all this kind of stuff. And probably about 9-10 years ago, I was standing in front of literally number 2 of Comcast globally. And he looked at the badge, and we used to have IP in our name. And he's like, IP, what do you guys do? And without a word of a lie, I literally stood there and went, because I knew if I said IP, this guy was going to run for the hills and I wouldn't have blamed him. And I went, intangible assets. Like I sort of had some issues. And it just sort of came out. And I used it in very much the literal sense that it's because I don't come from an accounting background. So to me, it was intangible. So it's non-physical and it's an asset. So it's worth something.
Mm-hmm.
But then I sort of discovered, in the 8 years following, that every time I came near anyone who had anything to do with, in particular, balance sheets, in particular accounts and CFOs, they wanted to get into this kind of technical discussion about how you bring this stuff onto the balance sheet. And I'll be honest, because I don't come from CFO background, I'm like, who cares? Like, why are we even talking about this?
That's interesting. So how do they take that? Because clearly the other part of what you're talking about here is, accountants want to basically work out pricing, what you're talking about there, which is goodwill, right? What is the value of it? So how do they take that? Because that is, to an accountant, that's basically like slapping them across the face.
Which is probably why I didn't have a lot of accountants as friends.
Yeah, fair.
And then I'd have to get into this technical debate of kind of unwinding kind of whatever their experience had been around balance sheets and all the rest of it. And, I quote the former CEO of Chartered Accountants, Lee White. Lee's opening line to me when he and I first met, when he was still at CA, was, hey, Michael, this IP stuff, I just want to let you know where I sit on it. I'm like, oh, okay. This might be a bit uncomfortable. He said, Michael, balance sheets are bullshit. They have been for 40 years. How do we work with you? Because we know the term's not IP. And it also wasn't intangible assets. And it wasn't until I met my very dear friend, Stephen Harrison, who you may have come across. And if you haven't, he's another one to get on this. Stephen was a client. And when we got out of the first lockdown in Sydney, he and I walked up and down Manly Beach for quite a few hours talking about this stuff. Because, like, I got your report. I've never seen anyone explain what you were trying to explain. Now, I do joke that we skipped up and down, but he doesn't like me saying that. But Stephen is, one of the most respected company directors in Australia. He's built funds, he's exited companies, he's done 15 IPOs, including Noble Oak recently, 0 to 155 million. It was Barrenjoey's launch IPO. And Stephen quite rightly pointed out, he said, look, I've heard you present and I think you're using the wrong term. And I'm like, Stephen, I know I'm using the wrong term. And he said, because what you're essentially doing is you jumped out of the accounting frying pan arguing with accountants. Or sorry, the legal frying pan, but then you jumped into the fire with the accountants talking about intangible assets. And he said, I think the term you're trying to really use is intrinsic assets. And we kind of went, okay, great, awesome. Went and Googled it and then went, oh my God, that's what Warren Buffett talks about. But then we went, what does that really mean? And the way that I like to explain it, because I'm a pretty simple person, grew up in East Bentley. Dad was a carpet layer, so I didn't grow up around balance sheets and all the rest of it. And myself and my other co-founder, Paul Davies, kind of sat back and went, hang on, let's kind of look back at the clients we've worked on. And one of the things that we worked out, and the data is been around for, at least the last 5 years, that 90% of the S&P 500 is unaccounted for. So if you take their market cap, less their fixed assets, their debt and their cash,
what are you left
there's
with?
90% of stuff. And so we used to focus on that 90%, the 90%, the 90%, the 90%. Until we went, hang on, it's not all the same. That 90% is not all the same. And depending on the business, it changes. And one of the ways that I like to think about it, let's just take, what's an example you and I know? The ABC. Okay,
Yep.
so 90% of, let's say the ABC, just for argument's sake, is non-physical. Now, I know they're not a commercial company, but let's say they were.
Yeah.
What you'll find is that 90% of, say, an organization like the ABC is actually pretty easy to replicate. So 90% of that 90% in volume is essentially worth nothing. Go and put up a website. I go and get some faces to chuck on the website to make me look like the ABC, but clearly I'm not the ABC. So what you then find is the next 9% of volume of pretty much every company is roughly where 9% of value will sit. And again, changes depending on the product or the service. But in the ABC's case, I would say it's probably their content. That I can't just go and replicate 40, 50, 60 years, however long, of content that they've got. But again, probably not hugely valuable. And the remaining 1% of volume is roughly where I would say actually probably all their value is. And in their case, they have a regulatory approval provided by the government to operate a TV and a radio license. And more importantly, they get government funding. Without that, there is no ABC.
Wow. Okay, that is huge. So let's take a few of those concepts, because I that is an incredible thought process in terms of what you've boiled down. That 1% really is where you've said the intrinsic value inside the ABC is sitting at. Let's go a bit further then in terms of bringing that out. Let's look at a company, if I can sort of put you on the spot, that is now on everybody's lips, something like Nvidia, and where that is now. I know that's really hard because again, at the moment, the speed at which it's moving has made it the largest company on the planet. It also then has chips that are clearly being made at rapid rates, but not at the same level of the price increase that's going on from its market capitalization and what have you. It's trading at, I think it's 40 or 50 times in terms of where it sits. So I want to come back then to brand and how, because this is probably what you're talking about here, is that intrinsic value, what differentiates a good company, good brand, good intrinsic value versus bad intrinsic value or bad business. Can you take me through some examples? Because we were talking offline before about, for instance, credibility, brand, your intellectual property, which obviously you don't like using because it doesn't sit in there. Take me through what you do and what you see with Intrinsica, which is your business, and what you now do as where you see that 1% or becoming 10%, which therefore is looking at, a 10 times increase in value of a company.
Yeah, and again, remember every company is different. So depending on which company you
I
gave me,
understand it's a very broad thing.
And so what you find And look, so we've tackled this at the high level. So
Yep.
you can break any company down into the 90, the 9, the 1. Okay.
Yep.
So that's the first thing to get your head around, is that this non-physical stuff, and it's actually quite akin to a balance sheet and a P&L. In other words, you break a P&L and a balance sheet down. You don't just have this jumble of numbers, because no one would understand it. Intrinsic assets are the same thing. They break down into these 10 categories like fingers. Okay. So individually, as we all know, if I've only got a pinky and I try and punch someone, that's going to really hurt me. So what you're trying to do with fingers is form them into fists. And that's what you've got to do with your intrinsic assets. And so, for example, if we take NVIDIA, and by the way, the 10 fingers are things like brand, knowledge, regulatory approvals, data, software, and I can just keep going. I won't give the full list, but
Oh, they're
there's 10.
great. If you can you give me another 5? I'm sure
Yeah,
listeners would love to hear it.
no, that's okay. And I'll come back to this in a second.
Yeah, go on, keep going.
So the thing is that with intrinsic assets, what you're trying to do is, first of all, the first thing you've got to do, and this is the classic mistake that we find nearly every client we work with makes, unfortunately, and that is that they don't even know what these things are. So I can sit down, and I've done this. I won't do it publicly, but I've done it privately.
Yep.
You put me in
Your
front of
intellectual
any
property.
company. Yep, any company, the CEO, the CFO, and in particular, if they are, as we talked about, listed, because it's really, really quite easy to work out. Because what you do is you take, for example, if we pick, NVIDIA, as we talk about, and we take what we would consider their 90%. So we take away their market cap, less their fixed assets, their debt, their cash. I haven't done this exercise, but I'm going to guess it's probably well over 90%.
Yep.
And if I said to their CEO, what is that stuff? The 90%. Could you give me a list of it? Here's what happens. The CEO will look at the CFO, who's normally next to him, who will look at the COO, who will then hope someone sitting next to him. And that is, they don't know what their 90% even is. They don't have a list of it. In other words, they don't know what these assets are. Now, they would probably guess, it's our brand or it's this, but they're guessing. It's not defined. What that means is they therefore don't know the risks. And if you don't know what your assets are, you can't know the risks. It's impossible. You're guessing again. But the third thing is, you're not then using them to grow the business. And the way, again, I like analogies. Again, simple guy. It's like driving a digger. If you've ever driven a digger, you need both hands, both feet. And what I found as a CEO is that for some reason, I always saw these levers off to my left. The day you come up with a product or a service, you've got to sell. So you've got sales. Then you normally got to send an invoice, which is finance. You then got to get better at it, which is marketing, which is really just applied sales. Then you have HR, so adding more people. Then in the 80s, we got, IT. In the 90s, we got the internet. And now we're actually getting things like AI. So they're the levers off to the left. Now, off to the right are our 10 fingers. And the 10 are brand, trade secrets, invention, which is essentially patents, software, know-how, data, relationships, design, content, and regulatory. They're the 10. Give me any company on the planet, I can break them down into those 10. Now, those levers off to the right operate with the ones on the left. For example, brand. So brand, people get confused. It's not your logo. Brand is not how you see you. It's how your customers see you. Now, brand obviously works with sales and with marketing. And so these things are working together. So as a CEO, I need both my levers. And so that's why I have a bet that no one's taken me up on yet, that pretty much every company in the next 10 years will have a chief intrinsic asset officer. Because right now, no one's in charge of this stuff. And it typically gets dumped in legal or finance, a bit like IT used to in the 80s. Now you couldn't run a company without a dedicated IT division, someone on the board that understands this stuff. So the intrinsic assets, and the reason we don't talk about IP, because IP, so if you've got everything that's non-physical, intangible assets, IP only covers, again, predominantly the legal rights. But again, it's kind of not helpful, because 99.9% of all patents are basically not worth the paper they're written on. And by the way, that's pretty much a stat from the former head of the US Patent Office.
Yeah, I remember that stat. I remember that coming out, just going, IP patents are, because again, how do you actually prosecute if you think somebody's taking your IP.
Well, the good news is you can, and that's a much more complex, which I'm happy
It
to get
is.
into. But the thing is that patents can be incredibly valuable. But again, they're like fingers, and like my glasses. It's like having, to me, a patent's like a really fine screwdriver. If I need to tighten my glasses, that's what I need. But I'm not going to probably build a house with it. It's not a hammer, it's not a saw. It's a really specific tool that you use in your toolbox. And so the reason that we focus on intrinsic assets, it's trying to work out, going back to that example with the CEOs, it's trying to enable the CEO and the strategic thinkers in the business, hopefully some of the board, to start to think about this stuff. Because again, if you sit in most board meetings, and unfortunately, I think most board meetings are focused on governance, whereas they really should be focused on how we're going to grow and increase the return on capital to investors. Because at the end of the day, unless you're a not-for-profit, that's your job, is
Yep.
increasing return on capital. Now, the strength of your intrinsic assets, this is something that a lot of people don't understand. And once people get their head around this is like taking the red pill in the matrix. The strength of your intrinsic assets is a direct proxy for your ability to generate revenue. And the example I use here is Uber. So Uber goes out and breaks regulatory. Remember, it was illegal. Melbourne, God, it was dominated by the taxi industry.
Yeah, and it's, they stop traffic over it.
Yeah. People were getting, locked up and fined and all the rest of it. But what Uber did, so Uber went out and built, pretty amazing business. But what they didn't do, and there's 4 questions we say any investor should ask, which we can come back to, but it's my 4th question. How are you going to stop or slow down a competitor? And clearly they didn't do a good job of that. Because after Uber spent hundreds of millions of dollars breaking the regulatory approval, Didi, Ola, Gojek, Grab, everyone else just came in behind them and didn't have to pay that. So they had a better return on capital. What that meant is, of course, Didi, Ola, and everyone else can always undercut Uber on price. And that's because Uber, whilst they broke down the wall at a castle, they didn't stop or slow down their competitors from following them straight through. So if they had, and let's say Uber was the dominant player, let's call it 100% market share. So they're a monopoly.
Mm-hmm.
What that means is they're able to capture all of the addressable revenue in that market. They can then convert that to either margin and/or market share, which is how you generate return on capital.
Mm-hmm.
It is that direct correlation between the two. And as I say to people, if you don't know the strength of the intrinsic assets as an investor or running a company, you're probably failing under the Companies Act, because your primary fiduciary responsibility under the Companies Act as a director is to protect and manage the assets. It's not even to grow them. If you don't know where 90% of your assets are, that's driving probably 90% of the value.
There's 2 parts to that. For the last part you just said, but let me come back to the other 3 questions that you said. So you said the 4th question was obviously about how do you stop your competitors? What's the first 3 then? Because the 4th question, that's a fascinating answer. What's the first 3? They must be even bigger.
Yeah, I probably gave the punchline. I shouldn't. Clearly,
No.
I got to get better at this stuff. But so this all sort of came logically to me. And again, Stephen, to his credit, at the end of, well, actually probably mid last year, said, "Hey, look, you keep asking these 4 questions. You need to turn these into 4 questions." And think about it when you look at an information memorandum. So you're going to go and raise capital, or you want to sell your business, whatever. So you need a document to explain to a potential buyer or investor. So think about it from their perspective. If you look at any IM, and anyone watching this, go and look at the last 10 IMs. I'm going to bet you that probably by page 5 or 6, you finally worked out the answer to the first question, which is, what do they do? In other words, most people overcomplicate, make too technical what they even do. The second question is, who are your customers going to be? And again, that's by page 12 or 13, if they answer it at all.
Yeah, I was about to say, I've seen IMs that can spend 90 pages and not tell you who that is.
And this is my point. But the third question comes from the first 2, which is, how are you going to generate a better return on my capital than the other 19 IMs I'm going to read today? In other words, why should I give you my money? But that's all affected by question number 4, which is how you're going to stop or slow down a competitor, because you can't do 3 without doing 4 effectively.
Hmm.
because otherwise it's a race to the bottom on price like Uber. So they are my 4 questions that any investor should be able to ask. Now, here's the crazy bit. Normally, one of the first things we do when we start working with a company is we ask the board those 4 questions.
So that was going to be my next part, because you've actually took me to it, which the other part that you said at the end of your previous answer was the board's responsibility. And around what board's responsibility is, it's obviously around the safeguarding of capital and these, the regulatory and requirements. But what you also said was that realistically, boards should be about growing and expanding the company that they're overseeing. Is this also part, particularly, for instance, one in my world back in economics, is that at the moment, business, particularly in Australia and across probably, a lot of Commonwealth countries, is anemic. The risk appetite is incredibly low. The forward capital expenditure expectations is either zero or going backwards. Is this because boards now are so pedantic about fiduciary and the possibility of legal ramifications and safeguard rather than expansion in their thinking? Is this also why, if we can get them to understand how you expand intrinsic value, that will therefore lead to better regs, better safeguard of capital, but also allow expansion of the business they're overseeing?
Evan, we might need a second podcast on this topic
Oh, I know, right?
because, look, this is something I'm deeply passionate about. And the reason I'm so passionate about it is because I'm the guy that should never be allowed on a board. I'm not an accountant. I'm, clearly, I'm not a lawyer. But if you go and look at, and Massimo Garbulo from Sydney University, who's an amazing guy, he and I met, he got engaged by the AICD to go and look at, to your exact point, how innovative are the ASX?
Yeah.
And guess what Massimo found? They're
Duck
not.
eggs. They're terrible at it, right? And then this is why I'm asking you this question, because at the moment, the fear that the ASX has and the fear that the business community has is that we have lost innovation. We have lost the ability to see capital expenditure, and therefore the government's now getting involved with this new concept they're bringing, which is productivity and improving productivity. It all sits in the same answer, does it not?
To a degree. So that's incrementalism. Okay.
Yeah, I know.
Incrementalism is not a good strategy. That's Kodak. That's Nokia. I could keep going. It's BlackBerry. And again, this is a really big topic we've just stumbled on. So I'm trying to give a succinct answer due to time. Look,
Don't worry about that. You keep going.
that's right.
This is incredible stuff.
So what I said to Massimo, again, because I grew up quite poor, so I've always been the guy that typically had to be street smart because I didn't have another option. And it kind of came to me. I said to Massimo, I think the reason they're not innovative is because think about who hires the CEO. It's the board led by the chair. Let's look at the makeup of boards. So some very, very high level anecdotal, non-scientific research is that roughly I think it was about 68 from memory percent of ASX boards, the people on those boards, forget diversity for a second.
Yeah, yeah.
Diversity in terms of their experience, they come from a legal or an accounting background. Therein lies
Regulatory
your
and bean
problem.
counting.
Yeah, and so with the exception of Kelly Partners, who we worked with, and Brett Kelly, if you haven't done,
Oh, I know Brett.
Kelly, oh, okay. So Brett's a client, and I would put Brett onto a board tomorrow. When we met Brett, his share price was, I think, 80 cents, and he and I have some similar views on some similar topics. So we met, and he's like, "Look, I need your help because the market doesn't understand my share value." Now, I'm not for a second saying that we did this. We gave him the tools to do what he then did. Last time I looked, it was at 1372 or something thereabouts. Because Brett is actually, I hope he doesn't mind me saying, he's probably a terrible accountant, but he's a great leader. And the thing is that ASX companies, in my humble view, and I'm probably about to piss off the whole ASX here,
I do
is
that
run
every
by
day.
management. Yeah, okay, we'll get along well then, Ian.
Yeah.
But it's run by managers, and being a good manager is very different to being a good leader. The leader does the things that are typically non-obvious. They're setting the pace, and whether you like him or hate him, Musk is a great leader. Trump is actually a great leader. I hate to say this, Hitler was a great leader. They were horrible human beings, But, think about what Hitler did in terms of unifying Germany for all the wrong reasons. And for those viewers watching, I lost my grandparents in the Holocaust. So for me to say that is, pretty brave. But
Tough.
leadership doesn't always mean they're good people. Leadership is the ability to get done through others. It's a Latin term. And so if I go back to boards, if you put people who are not leaders onto your board, guess what? That is your culture. And my background's org psych. And what I can pretty much tell you is the way you change a culture is you've got to change the individuals within it. So if you're not an entrepreneurial company, you start with the board, because the board will then hire an entrepreneurial CEO who will hire an entrepreneurial management team. So I'm not saying bet the farm. I'm not saying that. But if you look at things like NAB Ventures, Muru-D. I think Muru-D's lost $488 million and is a Telstra shareholder. Not very happy about that.
Mm-hmm.
And that's what we call innovation theatre. So that's where they go and spend all this money, normally hiring a 28-year-old, and this is a true story of a client that we came across, a 28-year-old who had a skateboard. That's why they made him the head of innovation and gave him an $80 million budget to go and literally blow up. And that's, again, it's good intentions, unintended consequences. And this comes back to a presentation I gave for the chief risk officers. And the president of that organization, I'd done 4 years in a row. I was up to year 5, and I'm like, what am I going to tell these guys I haven't already told before? And what it made me do was think about risk. And the problem we've got with the word risk, and this, you've already touched on this, Evan, and I learned this when I did my psych degree. I don't know if you're aware, but there's actually 2 kinds of stress. There's what's called distress, and what we've all done is basically we all see distress as stress. We've just shortened it from distress to stress. So when someone says stress, we see it in the negative, which is distress. The opposite of distress, though, is actually called eustress, EU stress. Eustress is literally what got you and I out of bed this morning. If you don't have a level of eustress, you pretty much can't function. And I applied this to risk. It was just one of my very rare moments of genius. And I thought, hang on, the day that someone starts a company, in the example I use here, I don't know if you're aware, but BHP was 8 guys in a pub in Broken Hill. That's how BHP started. Every company starts as a crazy person with typically a much worse idea for a much longer time before it becomes a good idea for a good period of time. And you've got to condense other people around you. So normally you are entrepreneurial, often by your nature. And as you grow that business, so you typically start off obviously at 0 revenue, and you're running at a negative margin because obviously you've got costs in the business. As that revenue goes up, though, you add people, and they're not all like you. And that's good. They shouldn't all be like you. But as we know, most companies will fire their founder, normally within 5 to 10 years. And that's often for good reason. They're not always the right person at the right time. But what they often do is, excuse the pun, but they throw the baby out with the bathwater.
Mm-hmm.
And that's where they'll normally put in a manager. And so what you find is their revenue kind of goes up and then it plateaus. But of course, everyone else is coming up. So what happens is a bit like momentum. If you don't put energy into it, it will slowly drop. And that's because they go from having high U risk and they focus purely on dis risk. So they start seeing risk as a negative. They're not realizing there's 2 kinds of risk. And again, I'm not saying you bet the farm, but you always want to be taking, as a business, a bit of risk. And I remember I was fortunate enough to meet, I'm pretty sure his name was Bob Flanagan, who ran Budget Rent-A-Car. And I'm going back to the early 90s. They were a client of mine. And Bob said to me something that's always stuck with me. He said, Michael, every year I do 10 new things. I'm like, oh, it's great, Bob. And what's your failure rate? He said, well, sometimes 9 fail. And of course, me as a very young, naive, early 20-year-old went, oh, that's bad. He went, no, Michael, that's good. I went, hang on, Bob, 9 failed. He said, but Mike, 1 could work. And if I do that over 5 years, I've now got 5 new things that my competitors hopefully not doing. Now, again, question number 4, you've got to stop or slow down the competitor. So again, as a CEO, you always want to be taking a little bit of that U risk to keep that organization fresh and growing, etc. And Apple's a good example. When Jobs left, they went like that, and that's because they really started to they weren't innovating, they weren't taking, they weren't as edgy. If you think about our mobile phones now, they really haven't changed in probably the last 10 years.
Yeah.
So that's the challenge for a board and therefore a management team, but it's always led by the board.
I want to keep going because I think I need to expand that next thing. Is that okay? How do you keep moving that momentum? Because as you said, I agree with you. Founders are fairly sort of existential. They tend to think in ways and words that are not aligned for companies that start to really expand. They also, they, as you said, baby with the bathwater. I'd also argue that founders see their business as a baby and sometimes get overly contracted to it, or the other way is that they just get bored and they want to do it again. So you've got this two side. How do you keep founder value and founder thinking going when you get to that plateau? Because you sort of said taking on a little bit of risk, but it's also how do you keep innovating? Is it like what we are now seeing? You alluded to players like Apple. You allude to also then players like, you know, Microsoft, Facebook, etc. What they're doing is that instead of being first mover advantage, they're being the ones that have got the guerrilla money and can just come and acquire. What is that middle ground in terms of how you keep founder thinking and momentum, but obviously with possibly the founder gone or that original concept being molded into what the now company will be into the future?
Yeah, there's a couple of ways that you can approach that. And look, again, it always comes back to what you're good at. In other words, what are your base, excuse the pun, intrinsic assets? And unfortunately, we saw this how not to how why don't we talk about how not to do it? Because most of what I've learned in life is how not to do things, which normally leads you to how to do things. And I use Hills as the example. You know, what 30 years ago they were the biggest brand in Australia. And Ted Pretty, who I've been fortunate enough to get to know, did what he thought was the right thing. You know, he tried to innovate. And he hired lots of people around him who said that they were good at this stuff. But in fairness, most of those people had never been on the battlefield. They hadn't done their own startups. They probably went and studied at university. Again, nice people, well intentions, unintended consequences. And the mistake that Ted unfortunately made is he announced this to the market. This was how not to do it. Because, of course, as you know better than I do, you know, you say to a market, we're going
I
to
doubt
do
it.
A, you better do A plus. If you do A minus, you will get penalized heavily. And unfortunately, that's why Hills doesn't exist today. Because as we know, innovation takes a lot longer than everyone thinks, and it
Hmm.
costs a lot more than everyone thinks. And if you're a public company, that's very, very difficult. So one of the ways you can do it as a public company is acquisition. And we've seen this model certainly play out, which is, you know, if our share price is say $10, and we acquire an early stage startup and, you know, we might pay not very much probably for that company, but it can add huge amount of value, depending on what the PE ratio is. And that's certainly been a strategy. But as we've also seen, what normally happens is the behemoth will normally kill that innovation and the founders leave with a pretty good exit, but the big company, the Telstras, et cetera, of the world normally have not taken full advantage of that. And that's because they've got very different cultures.
I'm going to. I need to get you back, Michael. This has been an incredible talk because we are running, unfortunately, out of time. So I'm going to ask you my last question, but I would love to reserve the right to have you back on and continue to pick your brain on an exchange. But Michael Masterson, if you're in charge for just one day, what would you do?
Uh, I would include what we talk about with boards and CEOs all the way through to founders. And I do have this dream, and we're actually working on this as an initiative with ASEAN, where I want to actually get this into high schools. Because right now, if you're at high school, you learn basic accounting, which is not a bad thing. It's good to understand basic accounting, but you're not learning this stuff. And if I could literally wave a magic wand, this would be how I would do it, because it will then almost certainly might not stop, but it will certainly have a pretty good impact on the 90% of startups that fail or companies that fail in their first 5 years. And that's because they don't understand their intrinsic assets. And all I can say to you is that I've been fortunate enough to be part of a high growth startup, and we were lucky. You know, I own that. We were absolutely lucky. You know, when we went from kind of six of us to 8,000, the initial six, we didn't get around going, right, okay, so what's our plan to get to 8,000? That never happened. And luck is not a strategy in my humble view. And if you can understand the rules of the game, and I can assure you it's not accounting or legal. Okay. Any lawyer will tell you, you know, what the law says and what the law does are two different things. And on the accountants, probably some accountants going, oh, how can he say that? Well, that's why you have your tax accounts, and then you have your management accounts. Again, that plays to the same thing. So again, if we could get to kids when they're 17, 18, and just educate them about this stuff, would transform economies. And we've seen this in Singapore. We worked with Singapore government, I don't know, what was that, probably 10 years ago. Now, Singapore was already doing a great job, don't get me wrong, but they then announced they wanted to become the intrinsic asset economy. And this is something that, again, we're working with ASEAN at the moment to look at how they can transform their economies. Because of Australia, there was a famous speech done by Sir Paul Callaghan, who was a pretty famous Kiwi. And I think it was probably at least 30 years ago now. He said, if Australia and New Zealand aren't careful, Australia is going to remain a quarry and New Zealand will remain a theme park and a dairy. What's changed? Not much. And at some point, both our economies, I unfortunately think, may get overridden, because we used to be, two of the most innovative countries on the planet. Kiwis, I think, still are. I think Australia is still pretty good, but just throwing money at commercialization and R&D and all the rest of it, which is what the government's doing. Look, again, it's well intended, but it's not going to move the economic needle.
No, I completely agree with that. That is a fascinating answer to that last question. That's probably one of the most expansive outvoices I've ever seen in his answer. Michael Masterson, thank you so much for joining Exchanges today.
No, thanks again for the opportunity, Evan, and great to finally meet you. I'm so used to seeing you on a TV screen.
You too. What an incredible topic. He's so passionate about it as well, and shows you very clearly that if you get it right, and if you listen and ask those 4 questions that Michael had, along with some of the other points, you can absolutely not just leverage your business, but your own personal movement, your own personal brand in whatever space you work in. Understanding your intrinsic value is clearly the way forward for how your businesses are. So with that, Michael, thank you so much for joining Exchanges. It was an absolute pleasure to have you on. And as I said inside it, I would love to get him back, because I think there is so much more we can get out of Michael going forward. To you out there, thank you as always for watching, listening, and doing whatever it is where you've got Exchanges from. We love having you as part of this overall community that is growing every day. Thank you so much for being part of it. If you do have any ideas or have any feedback, please don't forget we've got an email. It's exchanges@evanlucas.com.au. Also, please subscribe to wherever it is that you're listening. It is part of how we grow, and we do need you to please click on that button. And don't forget to leave us a review as well. But once again, thank you as always for listening. Thank you again to Michael for being on. And until next time, have a great week.